Over the past 25 years, as our client list has grown from 6 to over 1,000, our team has navigated frequent periods of market volatility, each with its unique causes and each met with discipline and perseverance. As the longevity and experience of our company leadership continues to grow, so too does our confidence in the future success we expect to share with clients for many years to come. Brian Friedman, our President and Chief Investment Officer of GHP Investment Advisors, took the helm in January 1999, 1 year before the dot-com bubble burst. Carin Wagner, our Senior Vice President of Wealth Management, joined the team in 2005 during a period of relative market calm, just as new bubbles began to form in emerging markets, oil and gas, and real estate. Mike Sullivan, our Vice President of Wealth Management, started in April of 2008, 1 month after the shocking bank run and meltdown of Bear Stearns, thus beginning the most devastating stock market collapse and bank crisis since the Great Depression. In January of 2010, Deirdre McGuire, Director of Business Development and Wealth Advisor, signed on with the firm during a year that included the stock market flash crash and the first of 3 Greek bailouts as fears mounted over the European debt crisis. Sebrina Ivey, Director of Wealth Management and Chief Compliance Officer, and Brad Engel, Director of Research, Trading, and Portfolio Analytics, joined us in 2012 in the wake of the U.S. debt ceiling debate and subsequent government credit rating downgrade. When wealth advisor Barbara Terrazas joined the firm in July of 2013, the Fed had just announced a reduction of its 3rd round of post-financial crisis quantitative easing, sparking a bond market taper tantrum. Wealth advisor Reed McCoy, Chief Investment Analyst Christian Luton, and Michelle Mills, Financial Concierge, joined in 2017, a pleasant year for investors with synchronized global economic growth across major economies, a short respite before the ensuing chaos of the global pandemic. These 10 long-serving leaders, as well as the rest of your GHPIA team, have helped your portfolio survive numerous pitfalls and disasters. We maintain a healthy respect for risk, uncertainty, and market instability while guiding your long-term wealth accumulation and preservation. No matter what the market throws at us on the road ahead, we look forward to our continued partnership.
Thank you. One of the things we wanted to emphasize with that video is not only our growth, but the longevity of our team. And that team today is highly collaborative. We communicate, we discuss, and we debate. And one of the reasons that when we get up here to speak, you're going to hear a single voice is because we try to refine our message. We are not one of these firms that you might have heard on the news when somebody gets up and makes a statement, or if they give a presentation, you might hear a disclaimer that says that this person, the views you're about to hear, reflect the person and not the organization. I want you to know that is not us at GHP Investment Advisors. The views you're about to hear reflect us, not each of us as an individual, and have been shaped over the course of time by a highly collaborative team process. And then secondly, as we hinted in the video, one of the things that gives me great pride at GHP Investment Advisors over the last 25 years is that in addition to the 5 of us up here, there are actually another 5 that could easily come today and take our place, and you would probably not even know the difference. And they include some of the people that we mentioned in that video today, but in most particularly in the context for what we're about to discuss, we have a whole research and analytical team headed up by Brad Engel, sitting back there, wave, and Christian Luton, our senior advisor, our senior analyst, wherever he went. I think he's still, there he is. So that's why today, all of the content is coming from the people to my right, starting with Mike Sullivan. And at the end of it, I will moderate the Q&A, some of which many of you were able to email us ahead of time. So let's begin. And we'll start with Mike Sullivan.
Actually, that's me.
Oh, excuse me, with Reed McCoy.
Switch seats.
And you switch seats on.
Sorry.
Where he's going to start beyond the peak, examining inflation's trajectory and implications. Reed, take it away.
All right. And the first thing I'm going to do is apologize for that title and how dry and technical it is. But I'm not going to take the entire blame because this is the first time that I actually used ChatGPT for a little help. And so I'm going to blame the robot on this one. But it is a little bit misleading because what I'm going to be talking about here today is definitely about inflation and the trajectory, where we are, how we got here, what the trajectory is, and why that matters. The implications as it pertains to investments, bonds, stocks, what have you, is going to be covered somewhat by the other presenters, with the exception of what I will cover right now, which is the implication from the point of view of the consumer. So if you are that type of person that doesn't get wildly excited about macroeconomics, and you're more concerned about just what the cost of a meal of burger is going to be next year, I'll give you that answer right now. It will be more. Now, fortunately, that amount more is likely to be measured in cents, not dollars, okay? Said another way, we are moving towards stability, price stability, but you should not expect prices to come down, and it might take a while until we get to the pre-pandemic levels that we had and enjoyed for the better part of 2 decades. Okay, so let me prove my burger thesis to you with lots of nice data and charts. So jokes aside, the prices of consumer goods and whatnot in our lives as consumers is obviously very important. On a macro level, what we're really concerned about, and the reason why stability matters, is because businesses and investors really need to make long-term plans. And although there's a lot of uncertainty that can be tolerated, really as a society, of course, we thrive on that predictability. And so for that reason, the biggest, most important question in terms of inflation is, are we moving in that direction towards stability or further away from it? And the answer I gave, obviously, in my opening is supported by any number of kind of charts I can show you here. But if we just look at the headline numbers of inflation, you can see pretty clearly that the trend certainly is moving down. Now, that trajectory is clear, but if you were to extrapolate based on that data alone, you might think that inflation is going to come down about as fast as it went up. And I'm not ruling that possibility out, it's possible. But if we look under the hood and we investigate some of the big pressures on supply and demand, the big, what I'm calling kind of tectonic forces that set in motion the inflation that we're experiencing right now, mostly legacy policies and things from the pandemic, there really is a case to be made that it could take a while for us to get back to that lower level and kind of target. At least certainly slower than maybe what this chart would suggest. So my go-to adage for describing the causes of inflation is it's too much money chasing too few goods. So that too much money and obviously the demand side pressures, well, on a macro level, that demand comes from rapid increases in disposable income, and that leads to an excess. Extra money in our pockets means that we have more money to chase limited supplies. That's important mainly because of how unique that case was in the pandemic. So the pandemic was the largest rapid increase of disposable income that we've ever seen. We now know by looking back that of the $5 trillion or so in COVID relief, about $2 trillion of that was saved, put into the bank. Okay, to put that into perspective, $2 trillion is more than the annual GDP of Brazil, of Canada, of Italy. Okay, so a lot of money that was just set aside that is now somewhat contributing and has been contributing to inflation. 18 months in from that peak period, we've depleted about half of that excess savings. That's still about 4% of our total GDP. Still a lot of money. Now, obviously, this is an unprecedented situation, and it's interesting on many levels. We can speculate about what impact it has been having on the labor force, on other specific sectors and products and services. We don't really know and won't probably until it's fully run its course. But the good news is it will run its course. There is a definite end to this. The unfortunate fact is that we just don't know exactly when that's going to be and how much it's going to really skew some of the data in the meantime. So, of course, the pandemic also created pressures on inflation from the supply side. So if we shift to that kind of too few goods and services, the story is pretty clear on the goods side of things. You know, COVID restrictions basically caused the slowing or the complete stoppage of production. We closed borders, and so all of that contributed to the scarcity of products and commodities that, you know, led to the issues in goods that we've been seeing. The services side, the labor shortage, you know, obviously we paid people to stop going to work, and it turns out they like that. So they're not going back necessarily as fast as we would like maybe. But back to the goods side, I mean, the scenario now is that as soon as COVID restrictions were lifted, world trade has more or less resumed and is strong. Pressure on supply chains has eased. Commodities have come down. Freight costs have normalized. So for all intents and purposes, the pandemic-related forces on goods and the kind of causes of inflation have all but returned back to pre-pandemic levels and just aren't representing much of a concern. What is still causing the concern is on the services side. The labor force participation is recovering very slowly. It's not yet back to the pre-pandemic levels, and even if it does get to that point, it was a bit of a problem before then, and it may still be an issue where we need more bodies, basically. And where we stand today, we have more job openings than there are bodies to fill them. This is important also because it's the main focus and justification for the Fed policy and the outlook of a slower return to the 2% target. And to defend the Fed somewhat, you know, that is a cause for concern. Lack of labor is causing wage increases to be resilient. However, when the conversation turns to Fed concerns about wages, often lines are drawn connecting our current situation to the 60s and 70s. And that's the last time that wages rose above 4% for any meaningful period of time. So you can see we've been in this situation now for less than 2 years, and already it's subsiding. So I think that it's important to, you know, take a moment here and just set to rest any notion that what we're in right now is anything like the 70s. And so comparing that same level of, you know, where wages were increasing above 4%, in the 60s, we were starting at 4%, and for the better part of 2 decades, the wages were escalating up to a peak of 9% before finally kind of falling. So meaning that the other, oops, sorry, wrong button. And the other meaningful difference is that for the first decade or so of that period, wages were increasing faster than inflation, meaning that disposable income was continually expanding, creating this compounding effect and what we call kind of a wage price spiral. And typically when inflation is higher than wage growth, the opposite or disinflationary effect is what happens, and that's where we are right now. That's the condition that we're in, is inflation already having risen above where wages are. So the 70s were also experienced some points like that, but were unique in another way, which is that they had to deal with high inflation while also dealing with high unemployment. So for the better part of that entire period, unemployment was above 6%. That created a policy objective, that were two policy objectives that were in opposition to each other. So policymakers really had to choose between stimulative policies creating jobs, or they had to try and curb inflation. And at that point, there was not consensus that inflation was as much of a problem until it got wildly out of control. Of course, at that point, Volcker, who was in the Fed at the time, stepped in, changed course with extreme monetary policy. So we're not in that position now. We have low unemployment. We have a disinflationary wage price cycle, and the Fed has already had a pretty heavy foot on the brake pedal for over a year. So it should be pretty clear that we're not in the same situation where we were in the 70s, and any fears of another decade or two where we're plagued by that kind of scenario just really isn't on the cards. It's also clear that the big tectonic forces that I was talking about, pushing and pulling supply and demand, they may support a slower momentum, but they're not signaling a shift in direction. There is one last stone to unturned, and it's less so what I would call a tectonic shift, as it is kind of more of a animal spirits, but it does carry some theoretical validity. And that's the idea that widespread expectations on inflation can, in and of themselves, create more inflation. and that could continue to either slow down or reverse the trends that we're seeing. If you look at the chart here on the left, the core sticky price index, it's a bit different than other inflation indexes that I wrote in my newsletter or that I've shown today, in that the weightings are adjusted and specifically designed to show consumer expectations based on their purchasing habits, not survey data, which is arguably less reliable. So as you can see, the consumer expectations are trending down as well. So we really don't see that as being any kind of apparent threat. Hopefully my presentation is also convincing some of you to, and I've done my part to kind of not stir up those animal spirits. The last point that I want to end with, and as I transition to Mike's outlook on equities, is another kind of consensus builder, which is expectations from the bond market. So the chart showing a 5-year break-even inflation rate, what this is implying is what the expectation is of the bond market over the next 5 years, average inflation over a 5-year period. So if correct, the bond market is signaling that inflation will be 2 to 2.5% average over the next 5 years, meaning for a good portion of those 5 years, we'll probably be at or near the Fed target of 2%. So I like that chart. I like the fact that it builds the consensus, but I also particularly like it because this data aligns really well with the way that we as a firm look at inflation when we're building portfolios, and that is to say that this data is coming from real investors with skin in the game. They're not just academics, they're taking some risk, and they're benefiting also from having a little bit of a longer time horizon and approach, which means that they can be less concerned with the exact timing that we return back to that 2% target, and can be more concerned with other things like the price of burgers or what have you. So with that, I'll leave it to.
All right. Thank you, Reed. For my portion today, I'm covering U.S. stocks and stock valuations. It's great to see you all. Thanks for being here. Although stock prices have mildly rebounded from the bear market lows that were experienced the fall of last year, corporate earnings are in decline. Companies continue to grapple with the high interest rates and inflationary pressures that Reed just summarized. I want to put this earnings decline into context and maybe assuage some of your concerns as stocks continue to languish for over a year now in this market slump. I'll also discuss profit margins, our allocation versus the broader stock market, and ultimately whether we view stock prices as undervalued, fairly valued, or expensive. To begin, the number one question I receive these days is whether we believe the economy is heading for a recession later this year. And to that, I usually respond by pointing out that we're already in a corporate earnings recession. We're looking here at the S&P 500 corporate earnings over the last 30 years. And over on the right side of this, you can see on an annualized basis, those columns on the right-hand side represent declining earnings for the last 3 consecutive quarters. The last peak of corporate profitability was at this time last year. But for 3 consecutive quarters, earnings have been in decline. The first quarter of this year just completed, and companies, although reporting a decline in earnings that wasn't as drastic as originally estimated, it still was the worst decline in corporate profitability since quarter 2 of 2020, which of course was the COVID lockdown quarter. So these 3 quarters of earnings decline represent what is essentially an earnings recession. But you can see just by looking at this chart, we're talking about the average investor today buying a share of the S&P 500 is getting, over the course of the last year, roughly $180 to $200 of earnings per that share. Over the last 30 years, just to put this into context, in 1993, on the far left-hand side of the chart, you see that that same share only fetched the investor about $24 of earnings. So taking a step back, the perspective I want you to take away from this is that there is always an ebb and flow to corporate profitability. Volatility is a sure thing, but we've seen over the last 30 years alone massive gains in long-term profitability. from $25 a share roughly to $180 or more per share. The prospects of corporate earnings falling in aggregate into loss territory is extremely remote at this point, from this vantage point. Keep this in mind as we expect earnings to decline further, most likely in the quarters ahead. Shifting to profit margins. Even with the decline in earnings, profits as a percentage of sales are still comfortably above average. Margins are normalizing back down from pandemic-era inflationary highs. If you look at the peak on this profit margin chart, it was about 17% in late 21, early 2022. To Reed's point, we, as macroeconomic thinkers, assume that when you have extremely high demand and very tight supply, what follows should be, if you're a company that's selling goods and services and you can get your hands on these things to sell to the public with that intense demand, you should deliver peak or near peak profitability. So it's no major surprise that we had peak profitability, multi-decade highs in profit margins over the last couple of years. And likewise, to Reed's point, we've seen the beginnings of the supply chain snarls easing. We have seen the beginnings of the massive consumer demand tapering back to normal levels. So it should follow that profit margins are coming down somewhat. But also to take away from this, coming down to roughly 14% where we sit today. In other words, companies are making a 14% profit on every dollar of sales. They remain highly efficient. The average profit margin over the last 30 years or so in this chart was roughly 8.5%. The lows were roughly 2% during the dot-com recession, a time when so many companies didn't even have a profit. Many barely had revenues. We're far from that era. Companies remain efficient. The stocks you own in your portfolios have sufficient profit cushion to navigate the challenges of still higher interest rates, higher labor costs, as Reed just mentioned, and waning consumer demand, as we would expect into the year ahead. Shifting gears to your GHPIA stock allocations versus the US broader stock market allocation. As we've mentioned so many times during these economic forum presentations, and we want to repeat, your portfolios are more diversified than the S&P 500 or the Dow Jones Industrial Average. However, when the media reports on declining earnings and rising stock valuations over this year to date or in the months ahead, they're likely pulling data from well-known large cap indices like the S&P or the Dow. That's because most market value is held by large cap companies. If you look at the pie chart on the left here, what you're seeing is the US stock market is made up 75% of large cap companies. The other 25% is spread pretty evenly between small cap stocks and mid cap stocks. Alternatively, our portfolios are allocated only 50% to large cap stocks, with the other 50% broken out in small and mid cap stocks. This is going to be important here in a moment when I talk about broader market valuations across the different sizes of companies in your portfolios. Another, taking a step back and looking at the big picture and kind of thinking back to that bus ride we just took you through over the last 25 years. The US stock market capitalization in 1999, when Brian began with GHPIA, was $14 trillion. Today, as you can see on the chart on the left, if you add all of that up, it's $46 trillion. Even during an ongoing market slump, when we look at the accumulation of wealth or the accumulation of stock market capitalization over the 25 years, that's over a 300% increase from 14 trillion to over 46 trillion in market cap. Just to give some comparison, In 1999, Japan was the second largest country by stock market capitalization. They were $4.5 trillion to our $14 trillion. Today, Japan is roughly $5.5 trillion. They've had a 25% increase in their market cap. We've had over a 300% increase. That is long-term wealth accumulation in the US equity markets. All right, finally, bringing this all together with stock valuations. We've always believed the best risk-adjusted, long-term wealth accumulation is achieved when diversifying investments across different sizes and styles of stocks and different sectors of companies within your portfolios. And this discipline is even more compelling when we assess current stock valuations. First, a quick study of price to earnings ratios across all three sizes and styles of companies. And by price to earnings, let's go back to just the basics on this. If we're getting a price to earnings ratio of 20 on a large cap company in your portfolio, that means we as the investor are paying $20 to pick up a share of that company, and it is earning us $1 per share on that $20 investment. Looking at large cap growth in value, mid cap growth in value, small cap growth in value across from left to right on this chart, you'll notice that all of these categories are below our benchmarks with respect to price to earnings ratios. Our benchmarks are that black line. Those are long-held benchmarks that we have always been highly critical of and very disciplined about adhering to them. If we own good companies in these categories and they are below our benchmarks, that's a pretty good sign of why we should stick with them long-term through thick and thin. This shows that either by our benchmarks or historical standards, stocks are not overvalued. Second, when looking at the diamond in these columns, the diamond here denotes the average or the median price to earnings ratio for each of these categories over the last 25 years. So what jumps out when looking at those diamonds is that mid and small cap stocks represent notably discounted valuations, even from those 25-year averages. And I think you could make a good argument that large cap stocks, even though slightly elevated on a valuations ratio or valuations basis from those 25-year averages, are only mildly above the 25-year average. Nothing like the dot-com era where we had extremely overpriced stocks in large caps. If profits or earnings continue falling, which is quite likely this year, then price to earnings ratios may rise. In other words, stocks may become less attractively valued. So it's encouraging that small and mid caps presently sell at discounts of approximately 20 to 40% below these 25-year PE averages. I should also point out, I'm focusing this presentation today on US stocks. As you know, we've always maintained a small percentage of your stock portfolios in foreign. Foreign stocks represent roughly 10% of your portfolios today, 90% US. Foreign stocks remain historically cheap on a valuations basis relative to US. So if we're talking about foreign or US mid-cap and small caps, all of those categories are at significant valuation discounts. But what you're probably hearing more about in the media is valuations that may be elevated or may become elevated in the US stock market. And they're likely talking about large cap stocks, which again, we feel are more around fair valuations as opposed to overvalued. Also, importantly, stock valuations become less attractive if interest rates rise. For example, if the borrowing costs increase for the companies that you own, their profits may become squeezed. Similarly, if bond rates are rising, to investors, bonds may represent a better alternative to stocks. And that's something we were talking about just outside this room. But valuations are at or below 25-year averages. And speaking of market metrics, hovering near long-term averages. The 10-year U.S. Treasury bond yield has averaged approximately 3.3% over the last 25 years. Today's 10-year bond yield is 3.4%. Interest rates are normalizing, which is something Carin's going to speak about in just a moment. By normalizing, what we mean is that over the pandemic era, interest rates were dropped to microscopically low levels, and they've come up from those lows. Over the era of the post-financial crisis, interest rates were held down at record lows to get through some of the secular challenges we were dealing with in the aftermath of the financial crisis. So it's really the first time in my career with this firm that I'm sitting and talking to clients about interest rates that are finally reasonable. But when we say normalizing, we're coming up from lows, but we're still only in those 25-year average levels. So although rates have climbed during the last 12 months, the 10-year rate has actually come down year to date, the 10-year U.S. Treasury bond yield. And rates are nowhere near levels that would threaten our current view that stock valuations are either fair or discounted. Although company earnings are in decline and interest rates are normalizing, profit margins are comfortable, and stock valuations remain at reasonable ranges, especially within a well-diversified portfolio. So going back to the bus ride and the video, we had fun making this video this year, and what we want you to take away from that, the quote was only on there for a quick second, but I pulled that quote from Isaac Newton because I liked the part relating to the madness of people. Here is this famous astronomer in the 1700s, mathematician. I think he's credited for inventing or at least developing calculus. And he says, I can calculate the motions of the heavenly bodies, but I am unable to calculate the madness in people. And the reason for this is he actually was an investor, and he was, unfortunately, had a major loss in an investment of one of the greatest bubbles of stock market history, which was the South Sea Shipping Company out of London in the 1700s. And in 1720, the South Sea Shipping Company, which was a joint stock, had reached enormously high or speculative levels, and there was a disastrous bubble that burst. It's said that Isaac Newton lost a modern equivalent of roughly $4 million. By the way, at the time, the South Sea Shipping Company's market capitalization was over $4 trillion, so it roughly doubles the largest companies here in the US, like Apple, et cetera. It was a major bubble, and I've read a lot about the hysteria of people who lost everything in that era in England, and the madness in the streets. Suicide rates were much higher after the bubble burst. Time immemorial, there is some sort of looming crisis we must overcome as investors. Today's version, we've got a regional bank crisis that's still unfolding. Carin's going to speak about this. The debt ceiling debate is unfolding in a very fluid way day to day. Sebrina's going to speak about this in just a moment. Recession worries we are discussing every day with our clients, with you. As long-term investors, we have confidence that reason will eventually overcome emotion, and stocks today are reasonably valued. I'm going to kick it over to Carin.
Okay, today I'm going to talk about bonds. And I'm going to start with a multiple choice question. I think that Mike already gave you the right answer, but if you weren't paying attention, we'll have a quiz at the end. So I'm going to talk about our bonds back. So A, yes, bonds look very attractive. B, no, bonds are still unattractive. Or C, bonds are sort of back. So keep that in mind. And he already told you the answer. I didn't know that was going to happen. So before I start talking about the changes in the bond market, I wanted to highlight that over long periods in time, stocks have outperformed bonds, and also just reiterate what Mike said, that we believe right now stocks are fairly valued. So keep that in the back of your head. When you're looking at the bar charts, you'll see that we have data going back to 1980, so roughly 43 years ago. And we have the Russell 3000 in gold. What that is that's an index of 3,000 US companies in comparison in gray to the 10-year Treasury. And if you look at that data, what you'll see is that there's been about a 4.4% difference in terms of annual average performance between stocks and the 10-year Treasury, which doesn't sound like very much until you do the math. So let's say that you invested $10,000 in 1943 at 11.4%. Today you would have $854,235,000 more than if you invested at 7%. So investing at higher returns over a long time makes a big difference. You'll also notice on the right-hand side that over the past decade, or call it 12 and a half years, stocks have outperformed bonds close to 10% per year. So keep that in the back of your mind as I continue talking about the bond market. So the good news is that we're finally starting to see some yields in bonds. And what we have up here is we have the US Treasury yields for the 2 and 10-year Treasuries going back to 1977. In gold, we have the 2-year Treasury. In blue, we have the 10-year Treasury. And I highlighted the 2% yield and the dotted line, and then put a square, a red square, around basically what's happened over the last decade. And what you'll notice is that we've been in a very low yield environment. Mike gave you the 10-year Treasury since 2010, but the 2-year Treasuries only yielded 1.09% per year over the last 13 years, so very low. But what you'll notice is there's been an uptick starting in about 2002, that we've started to finally see some yield on bonds. 2 years ago, on May 10th, the 2-year Treasury was yielding 0.14%. That was point. Today, it's yielding 3.95%. So what we've seen is we've seen a huge increase that works out to about 2,600% increase. By the way, I had to have help with that math. That was a big increase. It's a lot of math. 2,600% increase over the past 2 years. So in about 2002, as GHPIA started to see yields in bonds, we as an investment committee decided that we wanted to start buying bonds, but the way that we would do it is in a really conservative way, because we want bonds to be the part of your portfolio that's not volatile. So what we did starting in early 2022 is we invested in laddered treasuries with yields not to exceed 2 years, with the idea that if interest rates went up, we would then have bonds that mature so that we could go buy bonds with higher maturities, or if bonds went down, we still had access to some of those higher yields. The whole intention was to hold these bonds to maturity. The other way that investors got exposure to the bond market was by buying bond mutual funds, which GHPIA actively avoided. And what ended up happening is that we had a rise in interest rates, and there were real losses in bond funds. When you look at these two charts, what we're showing you examples of 4 different bond mutual funds. We could have pulled from many bond mutual funds. We just grabbed these 4, really highlighting that there were losses. And you'll notice on the left-hand side, we have short duration bond funds, and on the right side, we have longer duration bond funds. Duration is a measure of a bond's sensitivity to interest rates. Bonds with longer durations are generally more sensitive to interest rate movements than bonds with shorter durations. So if you look on the left-hand side, you'll see that we have 2 bond funds. Both of those durations didn't exceed 2 years. The bond fund in the gray is the Thompson Bond Fund. The bond fund in the gold is the Mass Mutual Short Duration Bond Fund. Both of those bond funds fell significantly in 2022. We saw losses of 9.4% on the Mass Mutual and 7.27% on the Thompson Bond Fund. Real losses. Even worse is longer duration bond funds. And we have 2 examples of longer duration bond funds there. We have in yellow the PIMCO Extended Duration Bond Fund with an effective duration of close to 25 years. That fund fell 39.85% in 2022. That's more than the market fell. That's a huge loss. Likewise, the double line long duration total return bond fund with an effective yield fell 29.25%. These are examples of the part of the market that we avoided. Rising interest rates affected mutual funds, but as many of you are aware, they also affected the banking industry, which led to the failure of Silicon Valley Bank, Signature Bank, and most recently, First Republic Bank. What I thought I'd do is I'd start with Silicon Valley Bank and just explain what happened and how interest rates really impacted this bank. So Silicon Valley Bank, most of its customers are tech companies and startups, and at the end of the year 2018, deposits at Silicon Valley Bank were around $50 billion. What you can see in the chart is that they skyrocketed and ballooned to having deposits of about $200 billion by the end of 2021. If you remember, that's also the time that we saw rising interest rates. So what Silicon Valley Bank did is they took those deposits and they invested in longer-term government bonds primarily. And you can see that on the right-hand side of the chart. You can see that what Silicon Valley Bank did is that they switched their portfolio and that they had most of their investments as held to security at cost. What this means from just a financials perspective is that as you have interest rate sensitivity, Silicon Valley Bank didn't have to book those losses until, if you look on the left-hand chart, all of these startup companies and tech companies started to withdraw their deposits, and Silicon Valley Bank had to sell some of these bonds that they weren't able to hold to maturity at a loss. And just to highlight, in blue, you have the 20-year treasury. 20-year treasuries were down 32.46% in 2022. So there were real losses. And as the pace of withdrawals started to spread at SVB Bank, the word got around and the bank became insolvent. Many of Silicon Valley's startup tech customers had far more than the FDIC insurance of $250,000. In fact, over 90% of the bank's deposits were uninsured. Just as a comparison, since many of you have money at Schwab, 80% of Schwab's deposits are insured by the FDIC. So in the end, what ended up happening is for those investors that had deposits exceeding the FDIC limit, the government came in, the US government came in and guaranteed all of those deposits at SVB Bank as well as Signature Bank. The depositors were made whole, the investors were not, so keep that in mind. First Republic's decline was different. First Republic, just like Silicon Valley Bank, was based in California. But what First Republic primarily catered to was providing really white glove service to the ultra high net worth. And so as a bank, they thought that their depositors' relationships were very sticky. And ultimately what ended up happening is as interest rates rose, the depositors left to go find yields in like treasuries and money market funds, and the bank wasn't expecting that. So as the latest bank failure, First Republic Bank was the third, and most of the deposits and assets were sold to JP Morgan Chase. Again, the depositors were made whole, shareholders not as much. So big picture, we have banking problems, but we're not back to 2008 crisis. We do not have the same credit problems, but we do have duration problems. So I hope that you all got the answer right, which is C. Bonds are sort of back.
So I feel like I've become the doom and gloom presenter in the last few years. Mike mentioned that there's always a looming threat, and I think everybody probably knew what the looming threat was, but our debt ceiling. So we were all kind of creative with our titles this year. I'm not sure this is a title, but I use this quote a lot. Americans will do the right thing after they have exhausted all other possibilities. I decided I should look up to see exactly when Winston Churchill said this, and it turns out it wasn't Winston Churchill. This isn't even the real quote. This is the quote that I like, The real quote is from a Israeli diplomat, something along the lines of, "The nations will do the right thing after they've tried everything else." This version of the quote is what I want you guys to keep in mind as we talk about the debt ceiling. Okay? It's actually been a real challenge to figure out exactly how to approach this, because every minute there is a new article coming out, a new opinion, so bear with me. I have not seen what's happened in the last 2 hours. So if it's all resolved, we can leave now and be done and start mingling. But I don't think we're quite there yet. So we're going to walk through and talk about what the debt ceiling really is. I'm holding this like I'm going to throw it. I'm going to put it down. The U.S. Department of Treasury website defines the debt limit or the debt ceiling as the total amount of money that the United States government is authorized to borrow to meet existing legal obligations. That includes Social Security and Medicare benefits, military salaries, interest on the national debt, tax refunds, and many other payments. If you have heard conflicting numbers on what the debt actually is, it's probably reflected in this first chart here. Oh, it's not there. This is why I was holding this. This gold reflects intra-governmental debt, and the blue is debt held by the public. So those are the two numbers that get quoted the most often. But let's take a step back and talk about the history of the debt ceiling, because I didn't know any of this before we started these presentations. Congress enacted the original debt ceiling in 1917 in an attempt to get support for our entrance into World War I. Prior to the debt ceiling being enacted, every time we needed to raise funds, it was a specific legislative action. So whatever we were trying to raise funds for, we had to pass a law in order to do that. In 1917, the act was the Second Liberty Bond Act, which allowed the Treasury to issue bonds and take on other debt without the congressional approval, as long as debt fell under a statutory ceiling. This legislation set limits on the amount of debt that could be accumulated through individual categories of debt, and it wasn't until 1937 that Congress limited the total accumulation of debt, creating the debt ceiling as we define it today. The debt ceiling has increased under every American president since Harry Truman. I had to look this up too because it's been a long time since elementary school. He was president from 1945 to 1953. Since 1960, Congress has acted 78 separate times to permanently raise, temporarily extend, or revise the definition of the debt limit. 49 of those times occurred under Republican presidents and 29 under Democratic presidents. This chart, I'm going to work this really well. This chart reflects the U.S. debt limit and total debt since 2010. The gray bars reflect the 7 times the debt ceiling has been suspended, and the 5 dots reflect 5 prior near misses where we are hanging out today. One important thing to keep in mind, the debt ceiling does not allow additional government spending. It allows or prevents the actual payment of spending that has already been legislatively approved through the issuance of debt when cash outflows surpass cash inflows. Some economists believe that the debt ceiling shouldn't be a concern at all. They believe that as long as the economy is growing, the debt will naturally shrink over time. Others argue that the debt ultimately has to be paid. Recently, the very legality of the debt ceiling has been called into question as a potential violation of the 14th Amendment. So again, I had no idea what the 14th Amendment does, but there is a statement in there that says the validity of the debt as authorized by law shall not be questioned. We'll come back to that statement in a little while. As financial planners, I think all of us get nervous at the concept of limitless debt and ongoing deficits. It causes me personally a lot of stress. But others argue that as long as there's someone out there willing to pay the money or to lend the money, it's available to be spent. My favorite quote, again, just on this topic, not in my favorite quote at all, because you guys know what that is, was in a CNBC article. I'm going to paraphrase it, where he likened the debt ceiling to someone walking into a bank, being given a credit card with no limit, demanding a limit, and then throwing a temper tantrum when they got to the limit. that's kind of where we are right now, temper tantrums territory. So again, once the deficit's reached, the federal government cannot increase the amount of outstanding debt, meaning it can only draw from cash on hand and spend incoming revenues. The U.S. hit the limit, $31.4 trillion, on January 19th. The Department of Treasury has been undertaking a set of extraordinary measures so that we are still able to actually write checks right now. Did anybody know what extraordinary measures meant before we started saying it in January? This is not the greatest chart, but we just kind of want to give you some ideas. There's 4 steps that the Treasury can take that are defined under these extraordinary measures. The first is issuing a debt issuance suspension period, which happened on January 19th, for the Civil Service Retirement and Disability Fund and the Postal Service Retiree Health Benefits Fund. That's a mouthful. The Treasury's declaration, the debt issuance suspension period, occurred on January 19th. It only applies to those 2 funds and allows the agency to suspend the automatic reinvestments as well as redeem certain investments earlier than scheduled. The second thing they can do is suspend reinvestment in the Government Securities Investment Fund, which is more commonly known as the G Fund, Retirement Fund for Federal Employees. They can halt the daily reinvestment of the Exchange Stabilization Fund. Operated by the Treasury, the Exchange Stabilization Fund is used to stabilize exchange rates by buying and selling foreign securities. They can also suspend the issuance of state and local government securities. Those are special purpose securities issued to state and local entities. In ordinary times, they issue those securities to assist in complying with federal tax laws from the issuance of bonds. Government debt is paid as it is due, and there's a large timing discrepancies always between the revenue that's received and the expense due dates. In 2023, an estimated 1/5 of government payments will be financed by borrowing. In any particular month, it can be much higher or much lower, just depending on the timing of the payments. This chart is reflecting the timing, well, actually both of these charts are reflecting those timing differences, so you can see the surplus and the shortfall in any given time. So again, if the Treasury uses all of its extraordinary measures in cash, the government has to pay all of its obligations using only revenues as they arrive, and revenues are generally taxes. If the revenues happen to cover the promised payments, the government could meet its obligations. There really aren't any reliable models for the impact of a potential inability to make payments, but these 2 charts summarize the U.S. government spending and attempt to reflect the number of people impacted by 2 of the largest programs, Social Security and the federal side of the Medicaid funding. Medicare is obviously another big piece of that, but a lot of Social Security recipients get that. So I think using these 2 charts and kind of understanding what the overall impact would be if suddenly a huge amount of cash just doesn't come out of the government that people are relying on is both scary and depressing. And it's what we're trying to avoid right now. So the Treasury makes hundreds of millions of payments, separate payments every single month. There has been some talk over the years, although not recently, members of Congress have introduced legislation that would prioritize certain types of payments over others. Under prioritization, certain programs would have that priority payment, but analysts believe that that would probably exacerbate the longer-term problems and cause really significant long-term issues to the lower priority option, so it's never really gotten a lot of traction. Even if prioritization was legal, under the current technology, the Treasury has indicated they don't think that they could do it. The government's payment system is designed to pay bills in the order that they're received. It relies on really old technology. So if you all remember thinking back to 1999, how hard it was to switch over the system, they can't do it in the time period that would be required. I have had a couple of clients recently say that, oh, the debt ceiling is just something that we go through all the time. It feels very much like it's part of the background sound now. But it's very real legislation, and there has to be some sort of a decision made in order to keep those payments going. We know they can raise the debt ceiling, they can suspend the debt ceiling, and we've been here before. We are in a very tough political climate right now, if you guys didn't know. And at times it feels like it is maybe potentially or purposefully dysfunctional. There have been other contentious debt ceilings in the past. This continued disagreement on spending, a narrow Republican House majority, and Democratic control of the Senate and the presidency are adding complications to any potential deal, but we have been here before. In 2011, a debate in Congress resulted in an agreement 2 days before the prior estimated liquidity exhaustion. So we'll go into a little history. Following the 2008 financial crisis, in an effort to gain control over the severe recession as well as address high unemployment rates, the government increased federal spending. The federal government reached its debt ceiling on multiple occasions from 2008 to 2011, leading to a series of increases. In 2011, the Treasury asked again for its borrowing capacity to be extended, but it didn't happen without repercussions. Standard & Poor's downgraded the U.S. credit rating for the first time ever, and the equity market saw their most volatile trading weeks since the financial crisis, dropping nearly 20% between July and early August. Following the 11th hour agreement, again 2 days prior to the estimated exhaustion date, the market had recovered by the end of the year and actually had some slight gains. I think it was about 2% for the S&P. So right now it's not necessarily possible to predict exactly what the Treasury will do, but they did have a contingency plan in place in 2011. Under that contingency plan, the first priority was to have no default on Treasury securities. The plan was to issue new securities and auction those off for the exact same amount as anything that was maturing at that time. The next step is a little more disturbing, where they planned to delay payments for all other obligations until at least 1 day's payment could be made in full. So again, maybe that's a few days, maybe that's a little bit longer, and all payments would have been delayed. Let's come back to current days. Since January, estimates of the potential default date have varied from the middle of June to early August. When we started deciding who was going to talk about things, that seemed very far away. So I was like, I'll talk about the debt ceiling. Things have changed. Actually, just recently, Treasury Secretary Janet Yellen and the Congressional Budget Office both adjusted their estimated dates for exhaustion to June 1st. That announcement came less than a week after a Republican bill to raise the debt ceiling passed in the House. That legislation included requirements to limit increases to the federal budget, impose work requirements for federal aid, rescinded an increase in the increase in IRS funding, and recoup unclaimed pandemic relief funds, so anything that hadn't been taken yet. The bill only narrowly passed in the House and is expected to go no further with the Senate. Democrats who control the Senate are insisting on a standalone bill to raise the debt ceiling without any conditions, and the Republicans are requiring that that any proposal has to include some spending cuts and policy changes. So kind of the same old, same old. For months, the Biden administration essentially refused to negotiate over raising the nation's debt, and as recently as April, the press secretary told reporters that avoiding default is Congress's responsibility and they should act on it without preconditions. Then this week happened, and yesterday I got to rewrite a lot of my presentation. Actually, yesterday there was a White House meeting with top congressional leaders, and that lasted for about 1 hour. Everybody came out and said, well, we didn't make any progress, but I actually would argue that there's progress in that they had a meeting and there's another one scheduled for Friday. Senate Minority Leader Mitch McConnell did tell reporters yesterday that the U.S. is not going to default, which I think also gives a little bit of, light at the end of the tunnel that feels like it's very far away. Also yesterday, I'm not sure that this made as big of a news, but attorneys representing a federal government employees union, representing 75,000 federal agency employees, filed a lawsuit against Treasury Secretary Janet Yellen and President Biden over the constitutionality of the debt ceiling, again going back to that 14th Amendment claim. And they are hoping that they can get an injunction that will prevent them from stopping payments. And getting the court to order to issue an order declaring the statute unconstitutional and unenforceable. So obviously we are right in the thick of it right now. I will close by saying that we do believe that an agreement will be reached, but we also believe that in our political environment, it's going to be slow and it's already been painful in coming. My personal hope is that our repeated warnings and crises will lead to real action. Maybe even recognition that just like in personal finance, you have two long-term options to curtail a deficit: raise your revenues or decrease your expenses. America will do the right thing. Even though we've been held against this debt ceiling again and again, maybe this crisis will breed resolution, as it often does. We have the opportunity to make more changes, but we also might not have exhausted all of our options yet. So I know that that's probably still a little bit doom and gloom, but that's where we stand today, and hopefully in a couple weeks you'll all look back at this as background sound.
Thank you. Before I open it up for questions, maybe I'll just comment briefly on Sebrina's presentation, because these days I'm the oldest one in our company, so I'm the only one that actually remembers the 1980s. And I know many of you in this room, not to imply anything, particularly for the ladies, might remember the 1980s as well. Social Security went bankrupt in 1986. It already happened, so we can all relax. What happened? Well, President Reagan at the time appointed Alan Greenspan, who later, 1 year later, became the chairman of the Federal Reserve, to the Social Security Reform Commission. So why am I bringing this up? Because I expect our fiscal problems in the future will be resolved in the same manner that they were resolved in the past, which is when everybody is looking to the left, Congress will do something way over in a corner on the right. So what did they do back when Social Security already went bankrupt in the 1980s? Firstly, they raised the retirement age. But what they did not do is raise the retirement age for those people that were retiring in 1986. Nor did they raise it for anybody that retired in 1987, 1988. What they did is they said, let's raise the retirement age for those younger people 10, 15, 20 years from now that have no idea what we're doing today. Which is why, when you look at what actually has happened since the 80s, you might not realize, but the retirement age has gone up for most of us roughly a month a year for 30 years. And there's actually different retirement ages. My dad actually had 65. Some of you, 66. All of us, 67 and 10 months. It's different for everybody because starting in the 80s, they began to raise the retirement age. The second thing that many of us may not remember is that the payroll tax was only 3.5% up until the mid-80s. They doubled it. They also did that slowly. So they raised the tax, they cut the benefit, they've raised the amount of income that that the payroll tax applies to. Oh, by the way, the Medicare Part B premium, how many people in this room currently pay a Medicare Part B premium? That didn't exist before 2003. And it's gone up every year since then. So in any case, welcome to how we believe things will change when we cut so-called government, air quotes, government spending. We don't have to do it tomorrow, but it will occur over the next couple of generations, and most likely in ways that we've already experienced for the last 30 years that without even realizing it for all of us in this room. All right, 2 housekeeping items, and I'm going to open up for questions. I want to thank Quality Lapel Pins. They were very kind enough to donate the lanyards today out there, and they are clients of ours, so I wanted to make sure they got appropriate credit and shout out. Thank you very much. And then for anybody that wants to enjoy the museum afterwards, see Claire. Where is Claire? Outside? There she is outside. She has the stickers for you so you can walk around the museum and enjoy it for as long as you would like. Okay, let me start by asking a question that we received by email from several people, and I'm going to turn to you, Mike. A number of people basically asked us, interest rates rose over the last year substantially. Why is it that even though lending rates at banks adjust, and in fact went up even more than what the Federal Reserve did, but yet all of your deposit rates didn't? Why is that? And what can we expect in the future?
And I'll be relatively brief so we can get in a lot of questions today. Long term, banks are always slower to respond to rising rates with regards to when they ultimately bring up their deposit rates. But the short of it is, banks, to a bank, a deposit is a liability. And if you are going to take on more liabilities, it's because you're able to loan more and you've got a robust lending environment. If you're heading into a declining earnings environment or a pre-recessionary climate, lending is going to tighten, and you may not want a lot of new liabilities or deposits. So it's not you don't want to incentivize with high interest rates for your depositors to bring in more. And two, Reed and Carin and my colleagues here, Sebrina, with the $5 trillion of fiscal stimulus, Reed quoted a number around $2 trillion that we can see pretty clearly landed in the banks. The banks were flush with cash or liabilities. So it's an environment where it's difficult to lend that out as easily as they would want to. If they take on too much, we see what happens with those that got a little too greedy. So they're always going to keep those rates a little lower. They're going to make a profit on the difference between the deposit rate and the loan rate. That's called a net interest margin. Those margins, those profits have been improving over this rate climate. So those are things that are long-term known quantities. We expect that when rates rise. We expect the banks to lag with raising their interest rates. But what is unique about this environment is that there was so much cash flooded into the system that the banks had to slow down how much they were taking on in deposits, lest they should wind up like a bank that wasn't able to cover their withdrawal. We've seen a few of those in the past few months.
Okay, let's open it up to questions. We have a microphone there and back in the back. Fire away. Don't be shy. Otherwise, I'll ask the questions of you.
Question for Carin.
Oh, no.
Put you in the hot seat. Explain a little more about the FDIC insurance on specifically the Schwab accounts that we have.
So right now, FDIC insures each account. Compliance officer, correct me if I'm wrong.
I pulled it forward for a reason.
So it's $250,000 per account registration. So you have an IRA account, you have FDIC insurance for $250,000 on that account. You have a joint tenants account, you have a $250,000 FDIC insurance on that. You have an individual account that also has its own FDIC insurance. So it's per account registration per bank. So it's at Schwab, but it's, let's say you have an account at Schwab and then you have an account at Wells Fargo, it's per bank, correct?
Yes.
Okay.
And remember, when we're talking about Schwab's FDIC insurance, we're talking about Schwab Bank's FDIC insurance.
To clarify what she's saying, money market fund does not have FDIC insurance. That's an actively traded position.
But just to allay your fears, the money markets that we, so almost everybody in this room know, some of you did have cash in Schwab Bank above the FDIC limit temporarily. Let's say you sold a house and money came in and went into that bank. But we moved, we're part of the problem. We moved all of the cash above that limit into the money market. But what type of money market? The money market itself that we own at the moment only owns short-term treasury bonds. So that's why Carin was emphasizing in her presentation what she calls duration risk. We own government bonds that have extremely short maturities, very short duration. In fact, what is it?
14 days, 7 to 14 days.
Yeah.
How do you protect investments with a possible future Chinese attack on Taiwan, and perhaps even an attack on Iran, some of the instability that we see coming fairly short term?
Well, I'm glad you asked that question. The main way is through duck and cover drills, if you know, so quickly get under your tables and pray. Those are excellent questions that, in all honesty, if we were to get into armed conflict with China, the market's going down. So there's no way to protect against that. So let's hope that we find a path forward that avoids that type of thing. Obviously, our military was engaged in 20 years of war in the Middle East. And we just showed the video where during most of that time, the S&P 500 rose by more than 400%. So it depends on the scale of the war, I would say.
I have two questions. With the $250,000 limit, that's been in place for as long as I can remember, granted my short memory span, but is there any plan, because people's assets have increased substantially over the decades, to increase that guarantee limit?
So I haven't read that there's been any long-term plan to increase that limit, but like we just saw with SVB Bank and Signature Bank, the government doesn't want to run on banks, and so it came in and insured all deposits over $250,000. So I think it's more the government's going to respond when there's an actual problem. Have you heard anything? I mean, I haven't read anything about it.
The only thing I've heard is that they're not planning to do it.
Yeah.
But that can change quickly, too.
The second question had to do with the government rescue. If the government, you may have answered my question, is going to step in any case and guarantee the deposits, where's that money come from? I know you explained they buy more debt, but is there a pool or something? Where's that coming from?
Aha! Yeah. You've discovered a fatal flaw. You want to?
I mean, it's coming from us, Lenny. And by the way, there has been a discussion in the immediate aftermath of SVB's failure of potentially going to $1 million of FDIC insurance. But of course, the political debate is that the $250,000, even though it's been somewhat static for years, it does present a sense of due diligence on the part of the depositor to ensure that the bank is operating prudently. So just to your first question.
You know, what I might just add is, if we go back to, I don't know how many of you remember the Euro debt crisis in 2011, 2012, about the same time we had our debt ceiling. There was this discussion of what they called the bank government doom loop in Europe. Why? Because in Europe, a lot of the banks are government owned. Or let's say in Spain, when they were private, the government was not credible because the government itself got into too much debt. Or in Italy, they had too much debt. So that the government's guarantee was not credible, because people said, well, yeah, the government says they're going to back up our deposit, but we don't believe the government is all that solvent to begin with. So you get into this sort of doom loop. So that's where the debt ceiling debate comes in. This time around, with some of the banking problems we've had, could we create a doom loop in the United States? Well, of course, there's a possibility, which is why let's hope Sebrina's right, that we get this resolved. On the other hand, if we go back, just like Sebrina emphasized, in 2011, Sebrina, in fact, when they downgraded the credit of the United States in 2011, what happened to interest rates? Do you remember?
I know yields didn't yields continue to drop because of the debt crisis.
Exactly.
You would have thought they'd erupt higher, like
Yeah.
we saw in Greece and parts in Europe.
Yeah, exactly. So they went down because people in that crisis had so much faith that the United States would maintain its obligations that, in fact, it didn't matter that they had a downgrade in the credit rating. The faith of the world stayed steady. I suspect that will continue even now, and that's why our government can credibly back up the deposits of the banking system. Whether they should is a whole other debate, which we won't have today.
Brian, my understanding is if I have an account at a bank, Wells Fargo, whoever, that account is insured for that $250,000. Now, if I have an account and it's in my name and my wife's name, that account is $500,000 insured. If then I add one of my kids, it's $750,000. If I add another, it's $1 million. Is that correct?
Yeah, that's correct, right, Sebrina?
Yep, that's correct.
Although you just gave $250,000 to your kids, but that's a separate issue.
And remember, you can also do it with a taxable account and an IRA account. Both in your own names would effectively give you $500,000 as well.
Are there some key takeaways you could give us that you think we should have gotten out of this presentation, because it was thorough and massive for a guy like me? Thanks.
I'll give my couple bullet points, and I would say, number one, Mike, this gorgeous man next to me. The stock market is reasonably valued, especially the way we invest, so don't worry. There will be volatility in crisis. There's always been volatility in crisis. But the way that we invest your portfolio, we will continue in the coming 25 years as we have in the past. Is that a good takeaway?
Sure. Yep.
I would say, Carin, her presentation, the gist was, it's very exciting that we can finally earn some interest on bonds. And oh, by the way, all that does is get us back to 2007 levels when we thought bonds were yielding bupkis. That's a technical term. They were yielding very little. So as high as well as they've done in terms of rising interest rates, it's not enough to retire on yet. And then Reed, I guess, what would be the key bullet point for what you had to say?
Yeah, I think just that the momentum that we have already established in inflation is likely to continue, but that it might still be a while, and there's going to be a little bit of pain and uncertainty getting to the point where we're back to the very comfortable 2% average that we had for the next 2 years. And so there is a lot of, I think, noise in the news and in the markets right now about that potentially changing direction, or some wage spiral or something similar to the 70s that could completely kind of derail the progress that we've already made. And that's just really unlikely and not our view.
The other thing to add is that we're not going back to 2020 prices. So when you go get that burger, it's still going to be $15. Just going to go up slightly. We're not going back to our $10 burger.
Yeah, that's a good point. You know, there's inflation, which, like you say, is the increase in prices. That doesn't mean that prices go down. And it reminds me, when we were younger, my brother and I made, for my dad's birthday, we made him something that we called the Nickel Museum. And it was everything that he told us cost a nickel in his childhood. And inside of it, we put little model cars and airplanes and everything we could think of, because in his mind, it should still cost a nickel. And that's exactly what I think we're going to experience for the rest of our lives. We remember what prices were in 2019. And we, even when they stopped going up, at least I know, because of, I just told you the genetic inheritance I received, I am going to think that they're too high for decades to come. Yes. And then finally, Sebrina, I guess my bullet point about your presentation, tell me if you agree. The government spends more than it takes in, When interest rates were zero, nobody thought about it too much. Even though interest rates are not back to the 1980s or even the 1990s, they are now at levels that we are going to have to think about and take very seriously. And so the political debate all of a sudden has come back to something that we forgot about, but is actually pretty familiar, at least in my lifetime, which is the Republicans now claim that they're the party of fiscal responsibility, and the Democrats are pushing against that. I don't know. I feel actually quite optimistic. I hope that's the political debate for the next several years. That would calm me down, frankly, if that's all we debated. I don't know about the rest of you. But the bottom line is, Sebrina is telling us the government spends a tremendous amount of money, and I don't know if you noticed those bars, on things that it can't change very easily. Medicare, Medicaid, Social Security, and oh, by the way, you didn't mention the number that between Social Security and Medicaid, that's 150 million Americans getting those checks and getting those payments. That's half of the country. So something is going to have to be done about it, is what Sebrina is saying. The problem will not be solved in the next 2 weeks. They will kick the can down the road. The question is it going to be at the 11th hour, the 12th hour, or the 13th hour? If it's at the 11th hour, your portfolios may not notice. If it's at the 12th hour, it might be a little rocky. If they do it like they did in 2011 at the 13th hour, an hour after they should have, there could be some significant volatility. That's what she's preparing you for.
Last question.
Yeah, question for Brian. We don't get a pandemic just every day. It's a pretty rare event. And associated with it, there was just a lot of doom and gloom. But I would ask you, what opportunities did the pandemic present, and what kind of opportunities does the pandemic present going forward?
Yeah, that's an excellent question, and most of us don't think about it that way. The United States government handed out 25% of GDP in cash, 85% of which went to the bottom half of the United States income distribution. We just experienced the largest wealth transfer to the lower half of the income distribution in history. Now, what did not occur, there was not a transfer from the rich to the poor. There was a transfer from the future to the poor. That's why we've created this debt problem. On the other hand, and this is exactly what you're getting at, that bottom half of the income distribution has more cash in the bank today than they have ever had in the entire history of this country. Unfortunately, what they can buy with that cash is now a bit more expensive than it used to be. But we have basically capitalized half of America in a way that we've never capitalized before. We probably can't afford to do it again. If there's another pandemic, another emergency, we will not do this because it will create an even bigger inflation issue, a bigger problem in the bond market, what have you. But that, to relate it to what Mike said, we're coming off that huge high of all that excess demand with huge profits and huge money in the pockets of everybody. It could have been the reverse. We shut down the economy. It could have been a Great Depression. So we flipped a Great Depression into an inflation, and inflation's always better. As we come out of this, people are going to be in excellent shape. They're going to be in good condition to maintain their consumer purchases. So we are going to have this readjustment of earnings, but we're doing it from a base of tremendous fiscal and financial health for the average household. So there is an opportunity out there, and it is something that I think is not our media that wants to make us angry all the time doesn't write about. And I guess, like I said, that's the silver lining.
I'd add to that as Reed was showing, labor force participation rate is still below pre-pandemic levels, and it's well below levels at the beginning of the millennium. So I think about this with my children. I mean, we have 9.5 million job openings and about 5.5 million that are declared as unemployed. If we have any kind of recession, it will be what's called a job full recession as opposed to, a jobless recession, that sort of thing. I mean, the kind of layoffs and joblessness that we saw post-financial crisis is unlikely to occur. So if there's an opportunity, maybe not necessarily an investment, but the stability of labor. Remember, 10 years ago, everybody was asking, are robots taking our jobs? Reed talked about ChatGPT. That's the new version of it's going to displace so many employees. We have almost 2 jobs available for every unemployed person right now. So that's one aftermath of an silver lining of the pandemic too.
I would just add too, to speak up for the younger generation who, if it's true that we are in a period here where valuations are going to turn out to have been potentially at a discount, right? For anybody who, let's say, graduated college during or after 2008, there has never been a period of time where if they're contributors to something like a 401k on a regular basis, that they've been buying in at a discount. And so for the regular generation that maybe is just kind of starting to accumulate or has been accumulating over the last couple, started to over the last couple decades, could be that this period that we're in now that was started at the beginning of last year, while it's never comfortable for us to see down markets and for us to see the balances of our portfolios down, it could end up being a really extended period of time that was a good opportunity for the younger generation to be buying into the market.
I want to thank all of you for coming. It's our pleasure to be your wealth advisors, and we are always here for your questions, not just during this lunch, but at all times. And we look forward to interacting with you and all of you watching by live stream in the future. Thank you for coming.
Thank you.